India's capital markets sit at over 250 lakh crore rupees. This immense wealth is largely invisible, tracked in secure servers and protected by digital locks. Before those servers existed, tracking market wealth was a physical, labor-intensive nightmare. Brokers and investors had to manage millions of paper certificates, relying on a system vulnerable to theft, loss, and constant manual errors. Ownership of a company used to mean holding on to one of these printed physical sheets. If a flood destroyed your filing cabinet or a thief broke in, your investment could simply vanish. NSDL solved this vulnerability by creating India's first digital depository in 1996, converting physical paper into permanent, highly secure computer numbers. This memo details NSDL's market position. They command an 86.1% share of custody value, equating to $5 trillion in securities. Moving down, we see who owns that wealth. NSDL's vault holds the bedrock of foreign institutional investments, mutual funds, and top-tier bank holdings. Guarding a $5 trillion digital ledger is a massive responsibility. But the challenge for a business is how to actually extract a recurring corporate profit from an invisible, stationary vault. To see how they monetize this, we can map NSDL's business model as a series of concentric rings. The innermost circle is the core depository, which generates 44% of total revenue and operates with high profit margins. This core engine runs on two primary mechanisms. The first is a yearly locker rent. Corporations and brokerage firms pay a fixed annual custody fee simply to maintain their digital records safely inside the vault. The second mechanism is a moving fee. Every single time an institutional investor trades a share or transfers an asset, NSDL charges a tiny toll for updating the ledger from one computer account to another. Because institutional assets must always be stored securely somewhere, this combination creates a highly stable, recurring revenue stream that is largely immune to market downturns. Moving one layer out, we find NDML, NSDL Database Management Limited. This subsidiary sells secure record-keeping technology to other sectors, yielding high profits despite making up only 6% of total revenue. NDML transforms secure record-keeping into active digital infrastructure. They operate mandatory KYC verification systems, manage corporate e-voting platforms, and maintain a massive insurance repository with over 154 lakh electronic policies. Finally, the outermost ring of the business model is the NSDL Payments Bank, or NPBL. Surprisingly, this unit generates the majority of total revenue, at 51%, yet it operates on a razor-thin profit margin of less than 1%. NPBL is a margin drag.
It brings in massive amounts of top-line cash through digital banking and micro ATM services, but after covering operating costs, it leaves almost nothing for the bottom line. NSDL operates this low-margin bank to capture massive transaction volumes. It embeds the company into the daily plumbing of India's financial system, establishing digital endpoints and securing a permanent role in capital movement. NSDL operates in a strict duopoly with their rival, CDSL. However, the two companies run on fundamentally different business engines. This table contrasts the duopoly. CDSL holds 18 crore retail accounts, capturing just 13.9% of custody value. NSDL has 4.44 crore institutional accounts. As noted, these $5 trillion custody clients don't pull assets or stop trading during bear markets. Looking at this profit trajectory chart, we can see the result of that institutional bedrock. NSDL delivers steady, compounding growth, with its annual profit climbing consistently to reach 380 crore rupees in the 2026 fiscal year. The primary threat to this steady growth comes from regulators. Because they operate as market infrastructure, bodies like SEBI strictly control fee structures and mandate revenue-impacting charge revisions at any time. They also face intense operational hazards. NSDL relies on third-party depository participants to reach users, and their entire model rests on maintaining robust security measures to protect against cyber threats and data breaches. Despite those risks, the macroeconomic trend is clear. The Indian economy is undergoing rapid financialization through new IPOs, corporate bond issuances, and foreign capital inflows. NSDL has positioned itself not as a passive storage locker, but as an inescapable toll bridge. Every time India's wealth grows or trades hands, a fraction of a cent drops directly into their vault.